Weak employment numbers collided with surging oil prices to create the first genuine economic signal we've seen since April. The VIX is running a low-grade fever, while earnings season exposes which sectors have built true immunity versus those merely surviving. One headline alone shifted the entire energy sector trajectory today. The data is screaming that smart money is rotating into beaten-down tech names rather than chasing momentum. SMH coughed 1.39% as semiconductor earnings revealed margin compression, yet Supermicro's 3-month decline created a contrarian thesis the Canary community has been watching. The consensus among our subscribers is to accumulate quality semis at current prices. Their thermal output suggests overheating was temporary, not structural. 10Y treasuries are running hot at 4.69%, with 0.69% intraday gains while TLT shed 0.66%. The pulse check indicates credit markets recognize the jobs report's warning but haven't panicked. Rate hike fears calmed enough that capital isn't fleeing to bonds en masse. Our metrics confirm this is a shallow correction, not a cardiac event, requiring defensive positioning across all sectors. UVXY plummeted 1.52%, while VXY shed 1.38%, meaning fear is cooling despite the jobs report's stark warning. The Canary dashboard shows a paradox: weak data combined with calm markets. This pattern signals institutional acceptance. Traders have priced in the slowdown and are waiting for clearer directional confirmation rather than overreacting to single data points. July jobs numbers of 23K plus BAS 103K previous revisions confirm cooling demand. Yet S&P 500 profit booms suggest business models remain resilient. The disconnect tells us corporate fundamentals outpace consumer weakness. Companies are optimizing costs before revenue impacts materialize. Our data indicates this lag creates a window where equity valuations can decouple from immediate earnings concerns. TLT down 0.66%, while bond flat at 0.28%, and GLD shedding 0.22%. Safety assets aren't rallying because the threat is perceived as manageable, not existential. The portfolio's natural defense mechanism, diversification into defensive sectors like healthcare, XBI up 0.39 mills and consumer staples, XLP flat, is functioning without requiring aggressive bond rotation. The market faces a classic two-headed dragon. Weak employment data threatens to drag demand, while surging oil prices threaten to squeeze margins through higher energy costs. Your portfolio is the hero, holding steady because it's diversified enough that sector rotations, SMH weakness offset by beaten-down tech upside potential, keep thermal stress manageable. The villain isn't crashing tomorrow. It's slow-burn inflation and earnings misses compounding over quarters, not weeks. Weak jobs data combined with rising oil creates a two-front threat your portfolio must defend against through quality selection rather than defensive positioning. The Canary is singing that beaten-down semis and energy names offer the highest risk-reward asymmetry for the next 30 days.